Large regulated banks have found ways to offer crypto products to their clients. JPMorgan Chase helps crypto exchanges, Coinbase and Gemini, with deposits and withdrawal transactions. Goldman Sachs has sold derivatives linked to Bitcoin while also making a loan to Coinbase secured against Bitcoin. And many banks offer wealthy investors access to crypto investment funds. Smaller US lenders have plowed more deeply into the crypto market, courting digital assets customers such as stablecoin issuers, crypto exchanges, and traders. These include Signature Bank, which has said more than a quarter of its roughly $120 billion in dollar deposits are related to digital asset customers, and Silvergate, which derived almost all of its $29 billion in deposits from digital asset clients. Well, the crypto carnage has one silver lining: the broader financial system has been spared so far. That is the silver lining so far. From Brussels to Washington, finance watchdogs have played down the risk of turmoil spilling into other markets and argue that their own actions have protected banks from the crypto tailspin. This contagion did not extend into the traditional banking and financial sector, according to the comptroller of currency in the US, that is Michael Hsu. This is what he told the Financial Times. According to him, this is due, at least in part, to federal bank regulators' continued and intentional emphasis on safety, soundness, and consumer protection. Global regulators in Basel, Switzerland, went further yesterday, the 30th of June 2022, to propose tougher rules to cap crypto exposure to 1% of a bank's assets. Federal Reserve, which recently released the results of its annual stress tests showing the largest US banks could suffer more than $600 billion in losses and still exceed government mandated capital levels, see limited bank exposure to crypto markets, according to Fed officials. Outside the banking sector, firewalls include investment guidelines for institutional investors that limit their exposure to digital assets, according to an official as well with the SEC. The official added that there were no signs the crypto sell-off had triggered a dash for cash from investors seeking redemptions of traditional securities to cover losses in crypto, though the SEC was still monitoring this activity. For mainstream asset managers, the direct impact of the crypto sell-off is pretty minimal, according to Ann Richards, chief executive of Fidelity International. Bitcoin made its way into a small number of institutional portfolios, but for most groups, is still very much on the fringes. Andrea Enria, the ECB's top banking supervisor, told the European Parliament committee yesterday, the 30th of June 2022, that there were still very limited connections between crypto and banks. According to her, she has noticed an increased interest by the banks to maybe enter these markets, as they see younger populations potentially very much interested. And she says, I also see in general greater instability in the sector, so the sooner we can regulate and give clear guidance, the better. So, wary of diving in too deep, banks have missed out on more than 95% of the four to $5 billion in estimated revenue for corporate and institutional clients generated in 2021 through digital assets, according to a report by Morgan Stanley and Oliver Wyman. Banks do have to go where the customers want to go to. So had there been customer pressure, they might have engaged in more crypto activity, according to Mitchell Itel, managing partner at the financial services group Sullivan and Cromwell. In the absence of banks, dedicated crypto lenders have stepped in. These companies typically fall into two categories: decentralized lenders such as Aave, where financing activity is tracked on its blockchain, and centralized lenders such as BlockFi and Nexo. Banks don't have crypto, and they've been very careful about lending against crypto. And in fact, most of the lending specialists most of the lending against crypto has been done by crypto specialists. So the overall exposure to crypto is very low, according to an expert. Crypto hedge fund insiders also appear relaxed about the extent to which these could affect traditional banks and their prime brokers and the wider financial system, because most of the traditional bank prime brokers that service mainstream hedge funds have yet to enter the crypto sector. Crypto funds tend to use specialist digital asset brokers, although they may still occasionally use banks when they trade more mainstream assets. This is seen as limiting the potential for banks to run up large losses when a fund blows up. Many large macro and quantitative hedge funds that have started trading crypto have done so using futures, for instance on the Chicago Mercantile Exchange, rather than the underlying cryptocurrencies themselves. If they were to suffer losses on such positions, they would have to post more margin with the CME or take cash losses with the DeFi exchanges, according to Usman Ahmad, the chief executive of Zodiac Markets, a digital asset trading venue owned by Standard Chartered. Neither of these should impact bank prime brokers unless those losses meant that the fund was unable to meet margin calls at banks that acted as brokers for the fund's other assets, he added. All this has led some Wall Street heavyweights to already come to the conclusion that the crypto mess does not pose systemic risk to banks. Well, calming statements by regulators have not always been prescient, notably in the run-up to the 2008 subprime housing crisis, when government officials downplayed risks. Not everyone is reassured this time around. So see what you make of the risk of crypto contagion at the moment, and thank you very much for watching this video.